Hey guys, Freaky Finance here. Today we're gonna do Spotify. So rhymes with Shopify, but totally different beast. Similar thinking. Honestly, you're probably getting a trend with these software companies. There's certain things that I look for, and Spotify is another one. I should disclose. I do own this one, so Spotify we're in at around 95. I'm currently at 460. It's shot up quite a bit over the last 2 years. Reason it actually sold off actually got cheaper than its IPO price in 2022, which was amazing, and it was right into their investor day, which gave me so much information. So I love investor days. Like tomorrow, ASML is at 5 o'clock in the morning, and I'm going to be listening to that because you get so much information, and you can kind of see like, do you believe in this, what they're going to try to do or not? And a lot of these tech companies, the investor days are so important because you can really get some crazy positive rate of change, especially if you believe in the business model. So anyway, we're going to do Spotify for most of this video. Then I'll do a little bonus on Suncor because it's one of the first positions we talked about on the channel. It's also one that's done quite well. I think it's over 50 something now, and we're in around 17 as an average during when oil prices started crashing during the COVID panic. So anyway, let's get into Spotify. Obviously, the results are good. You see the stock pop again, even after going up like 100% in a year. A part of that is the continued growth, and a large part of it though is the free cash flow. And you're seeing that operating margins are going from 1% operating margins to 11% in a single year. Yeah, that's not a typo. That's something special here. We're going to talk about some of the catalysts, why we're in it. It's kind of a good trade recap actually for Spotify. Obviously, you have revenue growth, you have the ad-supported growth, you have premium sub growth. Spotify makes money from subs, so actual people paying each and every month, which they've been raising prices on, and also on ad-supported, so getting more ad dollars for the free tiers of Spotify. And you can see, even though they raised prices, it hasn't really slowed down the MOU growth, and it's improved margins dramatically. So we'll jump into the numbers in a second, but these are just kind of some of the headline things. Again, just showing off the free cash flow going from 216 million the quarter last year to 711 million this year. So again, meaningful step up in free cash flow. And this takes me back to December 2023. Basically, Daniel wrote a letter basically removing 17% of the employees. So kind of similar to yesterday's thought process with Shopify with the 20% head cut. Spotify also did a 17% head cut. And this was partially because of just people overhired during 21 and 22. Here, so a balance sheet, I mean, for the tech companies, you almost don't even need to understand a balance sheet because it's literally high cash, low debt. They all, because of how, I mean, Spotify was a little bit different than the other ones, but just because of where it started. But a lot of these tech companies' only source of financing has been equity issuance, right? It went up through the whole venture capital channel, and basically all the venture capital guys are like, don't take on debt, and a lot of the founders don't want to take on debt because they understand that debt is really, it's a way for a bank to get a string on you, right? Get some hooks in. Now, it's not always true. Debt at a certain time is a good because it actually lowers your cost of capital relative to equity. But right now, because whenever the equity is very expensive, technically your cost of capital is very cheap. And a lot of these tech companies understand that the share price is a currency, right? So anyway, that's neither here nor there. But again, another immaculate balance sheet. You got about 5.9, or just call it 6 billion in CCE in short-term investments, and you have another 1.6 in long-term. And on the debt side, you have exchangeable notes, is 1.3. So again, net positive in terms of net debt, which is to be expected. The income statement, now this is what's very special, and this shows up like crazy this quarter, and that's probably why the share price has done so well this year. And again, you had to remember they did a 17% headcount right around December 2023. So this is before the headcount reduction, the comp year, versus now where we're seeing the headcount reduction. So you're seeing costs go down year over year in G&A, costs go down in sales and marketing, costs go down in R&D. And it's been that way this year. It's just even more exaggerated now. And then you have obviously the profitability profile of the company continue to improve. So revenue growth shoots up. You're seeing gross profit up 50%. That's without the headcount reduction, right? So you're seeing multiple expansion at the same time you're seeing cost control, and the market loves that. And you're also seeing a non-response to price increases so far in the MLU growth driver. in terms of rate of change percent growth. So, and another way to view it is you're also seeing $630 million more in revenue year over year, but you only had to incur $250 million in cost to get it, right? So that's another, you're seeing multiple expansion. When you raise prices, generally you get multiple expansion, though that's not always true, but in this case it is. Overall, you see the earnings per share go from basically losses to profitability, and you're gone from 30 cents in EPS last year to $1.40. So material step up in profitability. And unfortunately, you're also seeing dilution. So what we go to the cash flow statement in a second. Yeah, maybe we'll just jump there. You can see the cash flow, like I said, shot up. We're at 1.4 billion on a 9 months versus 300 million this time last year. But what are they doing with the cash? They're doing nothing. So that's why you're seeing stock dilution, because they're all getting paid in RSUs still, even though stock-based comp is actually lower year over year, which is different than some of the other companies we talked about, specifically Airbnb and Pinterest. Their stock-based comp is actually low. Now we're expecting that, in my mind, for Airbnb, we're expecting that to slow down in 2025. So it'll be interesting to see how the market treats that, because I have a feeling it's going to treat it similarly to how it treated Spotify. Anyway, here you just see the cash go on the balance sheet go up. So you bring in 1.4, you put 10 back in the business because it's a very capex light model, and you basically left with 1.4 billion. And then you can see it cash going from 1.6 to 3.1. So pretty much the whole CFO is going to cash on hand. So they're basically just allowing the cash on hand to build on the balance sheet. So what that means is that at some point they're either going to buy something or they're going to start buying back shares. Now, the share price is very high, so it's unfortunate that if they start buying back shares right now, right? But technically they didn't have the cash during 2022 and 2023. Right? The cash flow just started finally showing up. So it'll be interesting to see what they decide to do with their cash on hand as it continues to grow. And a lot of these guys don't pay a dividend at this point. A lot of them like to try to reinvest back in the business or expand their offerings. And you're seeing scale. So again, R&D scale, 11% of revenue going down to 9% of revenue. Sales and marketing, 11% of revenue going down to 8% of revenue, and then G&A, 4% of revenue, 3% of revenue. So scale again across every single line item. That's what I love to see on these tech companies over time. And to be fair, so there's some quarters when we don't see scale, and then I kind of explore why, right? I want to see if it's just something one time. Sometimes there's a legal fee, sometimes there's something in it, right? That makes it noisy. But over time, I want to see continued scale on all these line items, right? That's what you need to see in these tech companies in order to warrant any kind of the valuations that they have, right? Especially some of them like Spotify, which can be very, very steep. Now you are seeing margin expansion across the board, and they were stuck for a while. And this is them taking price. Though we're also seeing it as supported over time, right? So you're seeing it in music and podcasts. Now one of the great things, we'll go into the earnings call in a second, but basically, yeah, actually we'll jump into it right now. So on Investor Day in 2022, they basically told everyone, like, we're not making any money on podcasts. And the market, this is when the share price was under a lot of pressure. And the market was like, oh my God, why are you investing in podcasts? It's not making you any money. You're losing money in it. And they're basically saying, now we're going to get 40-50% gross margin potential in this business. And they're at the same time, they're guiding to margin improvement finally in the music business because they're finally raising prices on the sub count. And we also knew that advertising was getting better for digital advertising because the ROIs on digital advertising are superior to linear advertising. That will only improve with matching and artificial intelligence, which we talked about a few times already the last 2 weeks. Anyway, they also, Mark didn't want to hear about audiobooks. So basically, Spotify, just imagine Spotify was music. And then Spotify's like, you know what, we also want podcasts. And so music was finally starting to scale, and then they decided to spend all this money on podcasts. And podcast was losing the money, so it was actually margin decretive, right? It was actually lowering their margin because they're investing in it. And so the market hated it, and then Spotify's like, well, we're finally going to do good in that, but we're going to do audiobooks. And the market's like, oh my God, here we go again. We're not going to see any margin expansion forever. And so the market hated it. Like it was so much, like if we look at a stock chart, you can see the IPOs, say in 2018, basically does nothing for a year and a half, and then shoots up during COVID to 311, and then goes all the way back down to 78. Now we got in, I think, sometime around here, which makes sense based on the timing of the investor day. So it would have been, I love investor days, right? So June 8th would have been on my radar. That's why my average is relatively low in the 90s, right? Not like we bottom ticked it, but it was still a nice entry. And now we've seen the other side where they're literally doing exactly what they said they would do. And we're seeing margin expansion. And we're also seeing the podcast margin no longer be a headwind, actually be profitable to the business. And audiobooks are starting to finally also be profitable, but we'll see. We'll see if that's the same in terms of magnitude of importance as the other two. But it basically has been able to expand into other offerings, and the market at the time hated that. They just wanted to see the actual business model work, and they were like, just bear with us, guys, give us some time. And so anyway, here we are with the margin finally shooting up as advertised, with growth at a premium. You can see material expansion, and then also an ad supported. Also, just as important, while they're seeing the margins improve on the core offerings, you're also seeing the expenses come in, like we just showed with the 17% headcount reduction in December 2023, which they're still comping against. So overall, just really strong results from Spotify, doing exactly what I wanted them to do. Though it was a nice setup, right? It was a really nice entry. And there's a lot of despair here, right? Just imagine if you're in this at 250 or 300 and goes all the way down to 90, right, or 70. That's a lot of pain to see. But if you looked at the track record of the business, and it didn't look that great, like the sub count was growing, but the margins weren't improving. It kind of reminds me of Pinterest, right? The MAUs keep growing. I mean, to be fair, the revenue's growing pretty well, but the margins aren't exactly that amazing yet. Now, it's not as stagnant as Spotify was, so maybe we won't get the same magnitude of pullback. But those are like the dream pullbacks, right? When you get a really strong business that finally corrects on valuation, right? Because this thing was never, like, even here, it's not like it's all of a sudden worth 465. The market's pulling forward what they've done recently, right? Which will be hard to comp, right? Because they literally just had a 17% headcount reduction while seeing the margin expansion on two of their business lines, their two main ones, right? And eventually there will be a pause in price takes too, right? Which will slow the growth rate, but that's neither here or there. I'm probably going to think about that this weekend, given how quickly it's run up. But that's Spotify. And then just a little bonus on Suncor. So Suncor actually trimmed it today again. So I've trimmed this about 3 times over the last year. So actually moved some of this into Vermilion, just because of how Suncor's outperformed Vermilion so hard. So we take some of the proceeds. That's what I like to do. Is something's gone up. Technically, the idea is worse usually, especially for a commodity, right? So what I do is I just trim the outperformer and go into underperformer as long as it's based on commodity prices. And Suncor, I mean, has it's best in class, right? One of the best. Like, if you do last man standing status for low oil prices for oil sands in Canada, Suncor will be one of the last ones to be shut in, just because of the break evens. And they've done a couple of interesting things over time as well. We're not going to go into them all today, but they've basically been able to consolidate Fort Hills finally. So we'll see if they can manage it better than they have, because it's been underperforming, I think, over the last few years. So anyway, this quarter, more importantly, net debt finally got hit. So they paid down, like Vermilion. A lot of these oil and gas companies have decided to pay down debt before they start capex creeping up. Now we are seeing capex creep up. That always seems to happen with commodity prices. But the first things they have done prioritize is paying down debt. So a lot of these oil and gas companies actually have the best balance sheets I've seen for a long time, especially in Canada, because they've got the shit kicked out of them for 10 years. So they've all been a little bit more guarded. Though that doesn't mean we're not going to see the same thing we always see, which is this. Production continues to go up. And when you see production only continuing to go up, eventually prices will go down. Though, again, short term, you never really know what commodity prices, right? You could see something happen in the Middle East and this thing shoots up and whatever I think goes out the window, right? So, and that's just the way of the beast with commodities. It's kind of like you don't take it personally if the price goes up or down. It's just kind of a bit of luck in the short run. Longer term, I mean, you get the demand of energy over time. And I'm more bullish on natural gas anyway, so I like to switch to Vermilion at this time, given how weak natural gas prices are relative to how decent oil's held up on a relative basis. It's still down year over year. You can see this here with the realized price for Suncor going from 82 to 75 in WTI. More importantly, in WCS, 69 to 61. The refiner spreads, you can see, also down year over year materially, right? But the business has held up. Like the share price has, the business hasn't. So that's why it's kind of like, okay, it's a decent time for me to switch into something that's underperformed. And if you look at the two, right, especially let's just do from 2020, kind of this is when we first started following both of them. You can see Vermilion got destroyed. It was actually doing okay, and then it just got destroyed. Again, a part of that was a huge dividend cut. Because a lot of people held it for the dividend, and then they had to pay down a lot of debt. Like their balance sheet was a lot worse than Suncor's was at the specific time, right? If we were to forecast like oil at $0 or $30 for a long period of time, Vermilion probably wouldn't have made it, right? So that's the difference. That's the difference between having a last man standing during times of serious stress in a commodity price. But anyway, you can see it kind of recover. Like if you were to fast forward, if you bought it at the COVID lows, you can see Vermilion for a bit there was actually outperforming. Again, this was because of the spike in TTF prices during the Russian invasion of Ukraine in February and March of 2022, right? And it shoots up right into the reporting period of those numbers, and then it sells off ever since as TTF has pulled back. Now, again, what I mentioned on Vermilion's call is that in 2024 we've actually seen the improvement in TTF, but Vermilion's price has lagged, and it's even lagged a business that has no exposure to the outperforming commodity, right? So it's basically this has gone down with small caps in general in oil and gas, especially if you compare it to like American companies, whereas Suncor is held in there. So that's why it's kind of an easier place for me to go from one to the other. And not talk about management and how well the businesses are run. It's literally just price and future expectations, as well as what's currently happening in the TTF market, starting to recover again, versus what's happening in Vermilion stock, which is nothing. So that's just kind of how I treat things. Again, it's a lot of information. Hope you guys like it, and have a great rest of your day.